Hey everybody, Marty Missouri here, the 9th of August 2024 with your weekly video update. A lot to talk about, but I am going to do my best to keep it quick. I'm going to jump around as I have been doing a lot lately. First of all, our economic index, our PW index, this week scored a minus 26. It was actually up 2 points. Got some improvement in the ISM services survey, but overall we're still in the area that says recession risk is too high to ignore at this point. That's going to continue to be my focus here on the videos, is kind of the macro, because that's the risk to this market. First point here, and I'm just going to rifle through just a few of my own internal notes. Fewer industries are hiring as businesses enter wait and see mode. So when we were below 50% here, the last time it was right before the very brief COVID recession nevertheless, 35+% hit the stocks. Prior to that, we did touch it here, 2015-16, we saw 16% hit the stocks, but no recession. Then right here before the Great Recession, bounced off of it a little bit here in the mid-2000s, and then prior to that, it was right when the tech bubble burst. Disaster for stocks, relatively mild recession, but we were coming off of valuations like I showed you last week, kind of like we're at right now. So we do need to be concerned with the ultimate extent of a decline coming from these valuation levels. Albert Edwards grabbed a couple of charts that I saw also on the Daily Shot this morning, and he just said, stepping away from the current turbulence and back to its origins, which are the risk of recession. And that is what has kind of been the narrative flip for the market. We're no longer trading up on bad economic news because the market now fears that indeed a recession may be looming. Therefore, bad economic news, of course, will bring a Fed rate cut or cuts in. But as I've charted for you, if we're talking recession, Fed rate cuts don't help. The recession has to work its way through, has to do what it does to corporate earnings when people stop spending, and stocks just can't sustain the kind of valuations that they're sitting at right here. So rightly so, the market's freaking out on weak economic news. And so his question is, are we at September '07, where a very slow burn slide into recession suddenly became clear to all, and then markets tanked? And he's using data that suggests that maybe small companies are hurting right here, and funding rates for small business loans is the highest it's been since September 2007. Chart that went with that is that loan availability for small businesses tends to coincide with rising unemployment claims. So the blue line is loan availability for small businesses. That's the dark blue line. The light blue line, inverted, is jobless claims. So when this number goes down, that means jobless claims are going up, and you can see the relationship here suggesting that we're talking recession. Now, speaking of jobless claims, it was jobless claims that got the market rocking and rolling yesterday morning. I mean, futures were flat to actually down at 5:30 a.m. And the minute the jobless claims came out a little better than expected, the market absolutely screamed higher. Now, what would that be all about? Because that was really the only data point. Well, recall 3 weeks ago or so, mid-July, I was talking about how extremely bullish the sentiment was. Everybody was on the bull side of the boat. Suddenly we get a few recession triggers, or ex-Fed Governor Bill Dudley suddenly is telling the Fed it needs to cut 100 or 200 basis points, where he was hawkish just seems like weeks ago, saying we need higher rates. So suddenly the market said, oh my goodness, and began to freak out. And then people rushed out of the bull side of the boat, and we had that precipitous decline for about 3 days. Historically speaking, it was no big deal, but you'd think the world was coming to an end in some of the media outlets. So then quickly sentiment got very, very pessimistic, right? Everybody's now on the bear side of the boat, fearing recession. You get a data point that says, oh, maybe recession isn't here yet, and then everybody freaks out and starts buying. Folks, these are the ups and downs that, sadly, pretty consistent with market topping patterns or bottoming patterns. Let's just put it this way. They're typical when we're at extremes. Keith McCullough, the CEO of Hedgeye Risk Management, they do a pretty phenomenal job if you follow them. He said, don't forget the biggest bounces in market history, all 10 of them happened during bear markets. These big updates are a sign of the bear market. He said that in his morning session this morning. Let's see, other stuff I have for you here in my notes. Consumer-facing industries during earnings season so far, unusually high miss rates in terms of revenue reported, consumer staples, consumer discretionary, et cetera. So that's something that says not so good things about the economy. ZipRecruiter, borrowing from Peter Bookvar's comments, he basically just kind of cut and pasted some commentary from their earnings call where they missed revenue by 27% year over year. As we look forward, the second half of 2024, navigating challenging labor conditions. The BLS says seasonally adjusted hires have declined every month year on year since August of 2022. Quits rate, when the quits rate goes down, people aren't willing to quit their jobs. They're hanging on to them because they're afraid of their economic prospects. That's a negative sign for the economy. Year-over-year decrease in quarterly paid employers paying ZipRecruiter reflects a reduced demand from small and medium-sized businesses. Slight decline on the quarter reflects the continued uncertainty and volatility in the labor market. People are picking up the pace of their own job searches, so people are looking more so for jobs. That grew by 22%, which is 12 percentage points more than they're seeing from their largest competitors. So again, these are not signs that would tell you the economy is in a good place. So they are even more cautious in their expectations for Q3. Yesterday's morning action, I said, was consistent with this flip in the narrative. Now good news is good news. I just talked about that. Everybody got excited about the weekly jobless claims. I got to tell you, that's a volatile number. So you want to smooth it out by using the 4-week moving average, and you can see what it's doing. And by the way, continuing claims were up 3,000 on Thursday. All people saw who were over on the bear side of the boat was something that said maybe there's not a recession looming, so they had to scream back into the market. I wrote a little bit here, and I'll talk about it for just a second, about this prospect for exit liquidity. Imagine you're a big institutional investor and you do the kind of work that we do, and you're looking at valuations and you're looking at the macro, and you're saying to yourself, yeah, it's just a matter of time. But let's say you compete on performance and you can't afford to underperform even in the short run. So you know the bubble's there, you know we're probably nearing the end, but we could be another 5, 10, 15% higher that you can't afford to miss out on. Suddenly the market cracks quickly, the yen, carry trade, I talked about that already, and weak economic news or data, and suddenly boom, 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 Thursday, Friday, and Monday, you get this double-digit decline in tech stocks and a high single-digit decline in the S&P, and you were caught holding some of that bag. Well, you need some exit liquidity, right? We need someone to come in and buy that dip. Suddenly, Goldman Sachs, I think, jumps in. Hedge funds are buying the dip. Not that they're not, but they need to inspire some buying because we got to get this thing wrapped back up so that we can have a better exit ramp, right? The Bank of Japan, junior officials saying that they won't raise rates, and further this freaking out in the yen and the yen carry trade during market turmoil. All that stuff helped. Thank goodness for those who need another, exit ramp. So if that's the case, it sounds like market manipulation, nobody's going to jail for this sort of thing, then there could be some job owning. I said it last week, remember, or I said it Monday, that it wouldn't surprise me in the least, and I mentioned the Fed, that you're going to get some commentary, and in a couple of good days, that Monday decline could be all but wiped out, and it was completely wiped out. Now, we're still down, notably, or looks notably on the chart, but Monday was wiped out, and it came with some job owning, and also a better than expected 1 week of jobless claims. So we've got to take that all with a grain of salt. If we continue to get relatively benign data, then we could continue to see this rally go. I mean, it could have short-term legs. Long-term, again, my thoughts if you're a regular listener, or certainly if you are a client. Back on July 16th, I talked about this massive rally we were having in small caps, and I talked about how we are big buyers of small caps at the beginning of a new cycle, or actually at the very end when you have a recession. Typically, it's during the recession when you want to start accumulating your positions. That's when the market tends to bottom. But I said, this is not a rally that we're going to be chasing. Small caps are up like 11 or 12% in just a few days. And here's that chart. So right here was the date of this blog post, and the Russell was up like 11+% during that time period. But then I pointed out that, this is also kind of consistent action with tops. I showed here back right before that 33% decline in 2022, right before the Great Recession, right before the tech bubble burst. And, I guess I want to say lo and behold, but I don't want to overdo it because you never know. We could come screaming right back. But here was the date of that blog post, right? And here is a retest of the high, and here we are just literally falling off a cliff. And that looks, eerily like a bear flag pattern. And if that plays out, we've got a lot further to go on small caps. I don't know that it's going to, but that's what that could turn into without too much trouble right here. If we give people another opportunity to sell into a rally, if you will. So since I'm now on the stock charts, here's the S&P 500 daily charts. We've had these bear flags that kind of keep playing out. I don't think this one is going to qualify at this point because that's just too much flagging there. So just, a snapback rally right up to this 5350 resistance is right where it stopped. A lot of congestion in there. Folks who didn't get out here, now they have an opportunity. So you could see some selling up against that. 5400 looks pretty compelling to me. It's the top of this gap right here. A lot of trading had gone on in there. That could be where this thing fizzles, if indeed it's going to. But if it breaks through there, then we can start having a conversation about, the next levels and maybe even retesting that all-time high. I'll be surprised, but I've been surprised many times by the markets. When you look at the momentum indicators, nothing's really gotten any good here. These are just kind of confirming the market movement. I've been telling you the weekly chart and the monthly I showed you last time, so this week I'll just show you the weekly. This is a not good look, folks. Remember, we had that engulfing candle right up here 4 weeks ago, and I said you typically don't just get a little bit of a single-digit decline. You tend to get something more substantial. This wasn't huge. This was big. This was, again, 33%. Both started with bearish engulfing candles, and both got some bounces here 2-3 weeks at a time before they ultimately rolled over. Did break out of a very obvious rising wedge pattern, retested it and failed it, back up to where we ended last week. So again, recaptured Monday's big loss. Still have a big fat sell signal on the MACD with bearish divergences on both of those momentum indicators. As for the NASDAQ 100 ETF, weekly chart, same kind of thing. Broke down below the uptrend line, big sell signal right there, coming off of overbought levels. Tested right here at the 50-week moving average, which is close enough to the 200-day moving average, which is key. So it's bullish that it bounced right off of that. You tend to test that during uptrends. When you fail it, then you tend to test that as resistance. You can see it happen right here before that 30% decline. And then once you lose it, you really lose it. So a dangerous place right here. Retesting the bottom of this trend line makes some sense. Again, this thing could go in either direction. At the valuation levels that I keep sharing with you, I'll just show you the price to sales. This is not the look of a beginning of a new, sustainable, robust bull market. This is a late cycle look. And so you got to be very cognizant of the risks that you're taking if you're going to pile into stocks on every dip that we get these days. I mentioned that, initial jobless claims action. This is still the trend you need to worry about. You can see how it's trended right before past recessions. You tend to get that, and then it's not long after that something breaks. Remember, though, this came down a bit, caused a rally. Continuing claims actually went up by 3,000. The ISM services went the opposite direction from manufacturing. This sparked a good sell-off last week. This probably helped the rally this week as well. Now, to put that into context, 8 of the 18 sectors that it tracks actually contracted, and the overall commentary was not robustly positive, but it was better on average. Remember, with these ISMs, it's just, did we expand relative to just a month ago? Above 50 is expansion, below 50 is contraction. So again, it was good, but it was not anything that would have you saying, whew, risk is over. And you certainly don't get that from the copper market, right? Copper is rolled over. Folks like to call this Dr. Copper. They say it has a PhD in economics because it's so ubiquitous, in terms of construction and everything, building and infrastructure. So a declining price of copper like that is kind of what you see as you go into recessions. I can't talk about copper, though, without thinking about China. The correlation the last decade plus to China, the Chinese economy has been very high. So it tells you something about the Chinese economy right there. One more time, because I keep hearing people thinking that when the Fed cuts, it's going to be party on. Well, it would be. And it may be for a period of time like it was here. But if indeed recession is looming, the Fed can cut like crazy and stocks are going to have to adjust to economic reality. So we'll see ultimately what goes on there. The yield curve, I explained last time why this has been the economic indicator or the recession indicator that it has historically. And remember, it's when it uninverts that we're getting really close. And here we are just right on the line where suddenly the 10-year yield would be back above the 2-year yield. And here you have the history, the red shaded areas being recessions, and by the way, very messy periods in the stock market. So folks, I think that's enough. There was more that I wanted to share with you, but I'm trying to keep these videos something short of a marathon for you. Typically, I'd be back about this time next week, but if we have a very volatile week as we get into it next week, or if I think there's more that I'm just compelled to share with a quick video, I will. Otherwise, midweek, you'll get the written commentary from me. And I hope you all have the best of weekends, and I'll talk to you again soon. Thanks for watching and listening. Take care. Bye-bye.